$17 billion. That is how much the federal government has already paid out in retroactive Social Security payments since February of last year to teachers, police officers, firefighters, and government workers who had been quietly receiving reduced checks, in some cases for decades, under two provisions that no longer exist. And roughly 500,000 of those cases are still being processed right now in 2026, with money sitting uncollected because the people it belongs to have not filed a claim. That is the first of 5 quiet changes to senior money in 2026 that most people have either never heard of, heard a garbled version of, or assumed did not apply to them. All 5 are already in effect. None of them arrived with a letter in the mail, and at least one of them applies to nearly every senior watching this video. That is what this video is. And stay to the end, the 5th one is a brand new system inside Social Security that launched in April of this year and that almost nobody knows exists yet. It can save certain recipients from one of the most frustrating parts of the entire benefits process, and it takes one form to activate. My name is Nolan Carter. I track the quiet rule changes buried inside government systems, the ones that decide whether the money you earned actually reaches your hands. I believe that if 5 separate changes already happened to your money this year, you deserve to hear all 5 in one place, in plain language, before any more of it sits uncollected. If this is the kind of information you want reaching you before it costs you something, subscribe right now. This channel covers exactly this, the benefits, the rule changes, and the deadlines that rarely get explained clearly until the window has already closed. Now, 5 changes, starting with the biggest check the federal government has written to seniors in years and the people who are still missing from the list. Number 1, the Social Security Fairness Act and the $17 billion in back pay that is still not finished. On January 5th of 2025, a law called the Social Security Fairness Act was signed. It eliminated 2 provisions that had been reducing Social Security benefits for over 40 years, the windfall elimination provision, known as WEP, and the government pension offset, known as GPO. Here is what those provisions did in plain English. If you worked in a job that paid into a government pension instead of Social Security teaching, law enforcement, firefighting, federal civil service, certain state and local government positions, and you also worked enough years in Social Security covered employment to earn a benefit, those 2 provisions cut your Social Security check, sometimes by hundreds of dollars a month, sometimes to 0. The WEP reduced your own earned benefit. The GPO reduced or eliminated your spousal or survivor benefit. Both are now gone permanently, retroactive to January of 2024. The Social Security Administration moved faster than expected. As of July 2025, the agency completed over 3.1 million retroactive payments totaling $17 billion. The average lump sum payment came to approximately $6,710 per person, with some receiving considerably more depending on how long and how heavily the reduction had applied. But here's what most coverage of this story stopped reporting once the initial payments went out. The job is not finished. Roughly 500,000 cases are still being processed. As of 2026, the complex ones requiring manual review. People with pension histories spanning multiple employers. People whose records cross state lines. People whose cases involve both WEP and GPO simultaneously. If you are in that group and you have not received your retroactive payment or your adjusted monthly benefit, call Social Security at 1-800-772-1213. When the system asks how it can help, say Fairness Act. That phrase routes you to a representative specifically trained on these cases. And here is the group that concerns me most. People who never applied for Social Security at all because the GPO would have reduced their spousal or survivor benefit to 0, so they assumed there was no point. That benefit now exists. It is real. It is payable. But it requires you to file an application, and under current SSA rules, your retroactive payment is limited to 6 months before your filing date, not back to January 2024, like the people who were already receiving benefits. Senators from both parties have pushed SSA to extend that retroactivity window, but as of today, the 6-month rule stands, which means every month you wait is a month of benefits you cannot recover. If you were a teacher, a police officer, a firefighter, a federal employee under the old civil service retirement system, or if your spouse was and you never filed for Social Security because you assumed it would be reduced to nothing, call this week. Not next month, this week. The benefit is real, the law is in effect, and the clock on your retroactive payment is already running. Number 2, the temporary subsidy holding down your drug plan premium is expiring, and nobody is explaining what happens next. This one is sitting in plain sight, and almost nobody covering senior finances is talking about it clearly, so let me lay it out. When the Inflation Reduction Act restructured Medicare Part D, introducing the $2,100 annual out-of-pocket cap and closing the old coverage gap, insurance companies faced a problem. The new rules shifted costs away from seniors and toward the insurers. To smooth that transition, the federal government stepped in with a temporary subsidy that held down the monthly premiums on standalone Part D drug plans. That subsidy has been absorbing cost increases that would otherwise have landed directly on your monthly premium. It expires at the end of this year, for the 31st of December 2026. When it does, the premiums that have been artificially held down are free to rise, and multiple industry analysts expect meaningful increases in standalone Part D plan premiums for 2027. Not every plan will be affected equally. Some will see modest bumps. Others, particularly plans that cover expensive brand name medications, could see premiums jump significantly. Here is who this hits hardest. Someone on a standalone Part D drug plan, not a Medicare Advantage plan that bundles drug coverage, taking 2 or 3 regular prescriptions, who has been paying a premium that felt stable and assumed it would stay that way. That stability was the subsidy. The subsidy is leaving. There are 2 things to do about this, and both of them happen during the Medicare annual enrollment period that opens October 15th. First, when your annual notice of change arrives this fall, do not set it aside. Look specifically at what your plan's 2027 premium will be. If it jumped, that is likely the subsidy expiring. Second, compare plans during the enrollment window using your actual medication list, not the headline premium, but the total cost across premiums, deductibles, and copays for the specific drugs you take. A plan with a higher premium and better drug tier coverage for your medications can cost less over the year than a cheap plan that moved your prescription to a higher tier. And if your income sits under $23,940 as an individual or $32,460 as a couple, apply for Extra Help, the Part D low-income subsidy, before the enrollment window opens. Extra Help covers most or all of your Part D premium, eliminates your deductible, and caps copays at $5.10 for generics and $12.65 for brand name drugs. If you qualify, the subsidy expiring does not touch you. Your home and your car do not count toward the resource limit. Apply at ssa.gov/extrahelp or call 1-800-772-1213. It costs nothing to apply, and you can do it any time of year. It is not tied to the enrollment window. Number 3, the $6,000 senior deduction and the phase-out math, nobody is showing you. You may have heard that seniors now receive an additional $6,000 deduction on their federal tax return. That part is true, but most coverage stops there. And stopping there is exactly where people lose money, because the deduction is not a flat $6,000 for everyone. It phases out, and where your income falls on that phase out determines whether you get the full amount, a fraction of it, or nothing at all. Here is the complete picture. Under the One Big Beautiful Bill Act, signed the 4th of July, 2025, individuals 65 and older can claim an additional $6,000 deduction on top of the existing additional standard deduction seniors already receive. For a married couple where both spouses are 65 or older, that is $12,000. It does not require itemizing. It applies for tax years 2025 through 2028. It is temporary, not permanent. Now here is the part that matters. The full $6,000 is available only if your modified adjusted gross income is at or below $75,000 for a single filer or $150,000 for a married couple filing jointly. Above those thresholds, the deduction begins to shrink. It phases out completely at $175,000 for a single filer and $250,000 for a couple. If you file married filing separately, you cannot claim it at all. What does that mean in real dollars? A single filer 65 or older with a modified AGI of $60,000 gets the full $6,000 deduction. At a 22% marginal tax rate, that saves $1,320 in federal taxes. A married couple where both qualify, with combined income of $120,000, gets the full $12,000, saving $2,640 at the same rate. But a single filer at $125,000 is well into the phase out and may receive only a fraction, and a single filer above $175,000 gets nothing. Here is the action, and it applies right now, not in April. 3 months remain in the tax year. If your withholding was set before this deduction existed, you may be overpaying. Call your pension provider or Social Security and adjust what is being withheld, or adjust your quarterly estimated payment before the September 15th deadline. One phone call now prevents a 12-month overpayment that you do not discover until you file next spring. And if your income is modest enough that you typically owe little or nothing in federal tax, this deduction may push your taxable income low enough that none of your Social Security is taxed at all. The thresholds for Social Security taxation, $25,000 single, $32,000 married, have not changed since the 1980s. But this new deduction reduces your modified AGI, which in turn can reduce your provisional income below those thresholds. Run the numbers. For some households, this is not a small tax savings. It is the difference between paying tax on your benefits and paying none. If your return is currently being prepared by someone who is not asking about this deduction, or if you file yourself and your software did not prompt for it, it may be missing. 2 free resources exist specifically for this. Tax Counseling for the Elderly and AARP Tax-Aide both prepare senior returns at no cost and are trained on exactly this provision. Book an appointment before filing season gets crowded. Now, 2 of the changes we just covered, the drug plan premium shift and the tax deduction phase out, both connect to a larger picture of how the rules around your money keep changing without anyone sitting you down and explaining the full impact. If you own your home, there is another set of rules doing the same thing to your property tax bill right now. 8 separate programs across all 50 states that can cut, freeze, or defer what you owe most with deadlines your county will never remind you about, and 3 specific traps that can silently cancel an exemption you already filed for. Every deadline, every phone script, every form that is the property tax defense playbook, link in the description. Now let me show you the last 2 changes. Number 4, the SSI payment schedule quirk that is catching people off guard right now. This one is smaller than the others on this list, but for the people it affects, many of whom are managing the tightest budgets of anyone in the Social Security system, it creates real confusion and real stress in the middle of a month when they are already stretching every dollar. Supplemental Security income is normally paid on the first of every month, but federal rules require the Social Security Administration to issue payment early whenever the first falls on a weekend or a federal holiday. In 2026, August 1st fell on a Saturday, so the SSA issued the August SSI payment early on Friday, July 31st, which means there was no SSI deposit landing within the calendar month of August at all. The next payment arrived on September 1st. If you are on SSI and you looked at your August bank statements and saw no deposit, nothing went wrong. Your payment was not missed, cut, or delayed. It arrived 1 day early on the last day of July, and it was counted as your August payment. The September 1st deposit is your September payment, arriving on schedule. Here is the detail that matters most for SSI recipients specifically. SSI has strict resource limits, $2,000 for an individual, $3,000 for a couple. An early payment landing at the end of the prior month could theoretically push your countable resources over the limit for that month. The SSA has a specific rule addressing this. A payment that arrives early because of a weekend or holiday shift is not counted as a resource until the month it was actually intended for. In plain terms, the funds from the August payment arriving on July 31st do not count against your July resource limit, only your August limit. So this scheduling shift should not accidentally disqualify anyone. But here is the practical reality. If you are on SSI and you also receive regular Social Security, retirement, or disability benefits, those payments follow a completely separate schedule tied to your birth date, not the first of the month. Which means in months where the SSI payment shifts, you may see 2 deposits arrive days apart at the end of one month and then a gap in the next. Nothing is wrong. The schedules are simply running on different tracks. The action here is awareness. If you are on SSI, check the SSA payment calendar for the rest of 2026 at ssa.gov so you know in advance which months will have an early shift. Budget around the actual deposit dates, not the calendar months. And if a family member or caregiver manages finances for someone on SSI, make sure they understand this quirk, because a missing payment that was actually paid early is one of the most common reasons people call Social Security in a panic when nothing has actually gone wrong. Number 5, the new system inside Social Security that almost nobody knows exists yet. This one launched in April of this year. It is called the Payroll Information Exchange, PIE. And for SSI recipients who work, it may be the most useful administrative change the Social Security Administration has made in years. Here's the problem it solves. If you receive SSI and you also work, you are required to report your monthly wages to Social Security every month. If your wages change, you report the new amount. If you pick up extra hours, you report it. If you miss a report, your benefits can be overpaid, and overpayments trigger a recovery process that can reduce your future checks. For someone managing part-time work on a modest SSI benefit, this monthly reporting requirement is a constant source of stress and a frequent source of errors that are not the recipient's fault. The Payroll Information Exchange changes that. Under PIE, the Social Security Administration can now pull your monthly wage information directly from payroll data providers, the companies that process your employer's payroll. Instead of you manually reporting your wages every month, SSA gets the data automatically from the source. There is one step required. You have to give SSA permission to access your payroll data. You do this by filling out Form SSA 8240, which authorizes the exchange. Once that form is on file, SSA receives your wage data directly, and you may no longer need to report your wages manually every month. This matters for a specific reason, beyond convenience. The most common cause of SSI overpayments is not fraud, it is reporting errors. Wages that were reported late, reported at the wrong amount, or not reported at all because the recipient did not understand the requirement. Overpayments lead to recovery notices, reduced future checks, and in some cases, benefits being suspended entirely. The PIE system removes the most error-prone step in the entire process and replaces it with automated data that comes directly from the employer's payroll. If you receive SSI and you work even part-time, even a few hours a week, ask Social Security about Form SSA 8240. You can call 1-800-772-1213 or visit your local office. One form, one authorization. And the most stressful monthly task in the SSI system potentially disappears. Now let me bring all 5 together into exactly what to do this week. First, if you or your spouse worked in a government job teaching, law enforcement, firefighting, federal civil service, and you were ever told your Social Security benefit was reduced or eliminated because of a government pension, call Social Security this week at 1-800-772-1213. Say Fairness Act when prompted, the WEP and GPO are gone. If you never applied for benefits because you assumed they would be zero, apply now. Every month you wait reduces the retroactive payment you can receive. Second, when your Medicare annual notice of change arrives this fall, look specifically at your standalone Part D plan premium for 2027. The federal subsidy holding premiums down expires December 31st. If your premium jumped, use the October 15th enrollment window to compare plans based on your actual medication list, not the headline premium. And if your income is under $23,940 individual or $32,460 as a couple, apply for extra help at ssa.gov/extra help before enrollment opens. Third, confirm that both the long-standing senior additional standard deduction and the newer $6,000 deduction were applied to your most recent tax return. If your withholding was set before this deduction existed, call your pension provider or Social Security and adjust it now 3 months remain in the tax year. If your income is modest enough, this deduction may eliminate federal tax on your Social Security benefits entirely. Fourth, if you are on SSI, check the SSA payment schedule for the rest of 2026 at ssa.gov. Know in advance which months will shift early so you are never surprised by a deposit that arrives on the last day of the prior month instead of the first. Fifth, if you receive SSI and you work, ask Social Security about Form SSA 8240, the Payroll Information Exchange Authorization. One form can replace the monthly wage reporting requirement and eliminate the most common source of overpayment errors in the entire SSI system. And here is the larger truth underneath all 5 of these. The system does not chase you down to hand you what you are owed. The Social Security Fairness Act restored billions in benefits, and there are still people who have not filed a claim. The Part D subsidy is expiring, and most people will find out when their January premium arrives. A $6,000 deduction is sitting in the tax code, and a meaningful number of returns filed this year did not include it. Every one of these was available the entire time. The only thing missing was someone explaining it clearly enough to act on. If you own your home, there is one more place where that same pattern repeats your property tax bill. 8 programs that can cut, freeze, or defer what you owe after 65, most with deadlines your county will never remind you about, and 3 traps that silently cancel exemptions you already filed for. The complete state-by-state guide, all 50 states, every deadline, 5 phone scripts ready to use is in the Property Tax Defense Playbook. Link in the description. One honest note before we close. Everything in this video is general education, not personal, legal, or financial advice. Social Security rules, Medicare programs, and tax provisions change and vary by individual circumstance. Always confirm your specific situation directly with the relevant agency or a qualified professional before acting on anything covered here. Now, here is what I want you to do with this. Think of one person, a retired teacher, a spouse of a firefighter, a neighbor who mentioned their Social Security check seems smaller than it should be. Send them this video. 5 changes already happened to their money in 2026. The system is not going to send them a letter about any of them. You may be the only reason they find out before it costs them another month. Subscribe to this channel and turn on notifications so the next update finds you before it costs you anything. Thank you for watching. I will see you in the next one.